Leverage is not a tool to accelerate your success. It is a weapon that magnifies your flaws. It will not make a good speculator great, but it will make an undisciplined one destitute with breathtaking speed. The market does not care how much you borrow. It only cares about the price, and margin is the mechanism by which a normal fluctuation becomes a financial emergency. Every man who has ever gone broke on Wall Street has a story about leverage, and it is never a happy one. I learned these lessons not through academic study, but from the brutal education of losing fortunes that would stagger the imagination. My entire life, the triumphs and the catastrophic errors, is laid bare in the book Reminiscences of a Stock Operator. If you wish to learn from my extensive collection of scars rather than cultivating your own, the link is in the description of this video. Treat it not as a story, but as a warning. The market teaches through pain, and leverage is its preferred instrument of instruction. Before you face ruin, you will be warned. Your own mind and body will send you signals of impending doom. The tragedy is that most men are too proud, too greedy, or too frightened to listen. Here are the 5 signs that you are no longer trading the market, but are instead being hunted by your own position size. The first and most reliable signal that you have crossed the line from speculator to gambler is when your position size robs you of your sleep. A man cannot make clear-headed decisions during market hours if he has spent the night wrestling with his own anxieties. The stock market is a game of intellectual and emotional stamina. It requires a clear, rested mind, free from the distortions of fear and hope. When you lay your head on the pillow and instead of sleep you are greeted by a phantom ticker tape running behind your eyes, you have a problem. You begin to calculate your potential losses on a gap-down opening. You rehearse arguments for selling and then counter-arguments for holding. You feel the physical weight of your commitment. This is not the sign of a bold operator. It is the symptom of a mathematical error. Your subconscious mind, the part of you that is tasked with survival, is screaming a warning. It understands the concept of ruin in a way your conscious, greedy mind does not. It knows you have wagered more than you can afford to lose, not just in terms of money, but in terms of psychological peace. I have held positions so large that the fate of my entire fortune rested on the next day's opening. The pressure is immense. It colors every thought. It turns your home into a prison of worry. You are not the master of your capital, you are its slave, and it demands a fearful vigil all through the night. The market requires your full intellectual capacity, and a mind clouded by fatigue and fear is an easy mark for the professional operators on the other side of your trade. They are sleeping soundly because their risk is managed. Yours is not. Therefore, the first and most critical rule of self-preservation is this: you must sell down to the sleeping point. This is not a suggestion. It is a command from your own nervous system. It is the most honest trading signal you will ever receive. The moment you find your sleep disturbed by a trade, you must reduce your line. Sell a quarter, sell a half. Sell whatever it takes until that cold anxiety in the pit of your stomach recedes. A good night's sleep is a non-negotiable asset for a speculator. It is more valuable than any potential profit from a position that is too large for your capital and, more importantly, too large for your courage. If you ignore this warning, you will eventually make a fatal error born of pure exhaustion. The second sign is an extension of the first. It is when you become a prisoner to the quotation screen. In my day, it was the ticker tape, a constant stream of paper spilling into a basket dictating my mood and my future with every new print. For you, it is the screen on your desk or the phone in your hand. The principle is identical. A speculator in a sound position with a clear plan and a defined stop-loss does not need to watch every tick. He has made his decision based on the underlying conditions. He knows his risk. He can walk away, have lunch, conduct other business, and live his life. He is the master of the trade. But the man who is over-leveraged is a slave to the quote. He cannot look away. His mind is locked in a feedback loop of fear. Every uptick brings a fleeting moment of relief and greed. Every downtick brings a jolt of panic. He is not analyzing the market's behavior. He is reacting to it, moment by moment, like an animal. This obsessive checking is not a sign of diligence. It is a symptom of profound insecurity in your own position. You are watching the screen so intently because you know deep down that a move of a few points, a sudden burst of volatility, could trigger a margin call and wipe you out. Your focus is not on the broad trend or the line of least resistance, but on the immediate, terrifying possibility of your own financial destruction. I have spent countless hours in my private office where the only sound was the clatter of the ticker. But when I was right and my position was soundly managed, it was the sound of opportunity. When I was wrong or too big, it was the sound of a ticking clock counting down to my ruin. The emotional strain of this constant vigilance is enormous. It drains your willpower. It makes you susceptible to every rumor and every meaningless wiggle in the price. You lose all perspective. The amateur, terrified and over-leveraged, tries to will the price to move through sheer force of observation. The market, of course, is indifferent to his stare. The rule is this: your trade should serve your life, not consume it. If you find you cannot leave the screen for an hour without feeling a surge of anxiety, your position is too large. If you check your phone for quotes during dinner with your family, your position is too large. If you wake in the middle of the night to see what the futures market is doing, your position is too large. A professional sets his conditions, makes his play, and lets the market work. The amateur, bound by the chains of leverage, is trapped in a prison of his own making, where the screen is the warden and every quote is another turn of the key. The third sign is when a normal market fluctuation begins to feel like a personal catastrophe. The market breathes, it moves up, and it pulls back. A stock that travels from 50 to 100 will not do so in a straight line. It will have reactions. It will shake out the weak holders. These pullbacks are not only normal, they are healthy. They are the market's way of testing the trend. For a well-capitalized speculator, these are opportunities to observe strength or, if the pullback is on low volume, perhaps add to a position. But for the over-leveraged trader, a normal reaction is a source of pure terror. When a one-point drop in your stock causes your heart to pound and your palms to sweat, you are finished. Your judgment is gone. You are no longer thinking about the trend or the sector or the volume. You are thinking only about your margin clerk. I learned this lesson most painfully in the cotton market. I had followed the advice of another man, a very successful cotton merchant named Percy Thomas, and built a line of cotton futures far larger than I should have. My own analysis told me cotton was going higher. But because I had violated my own rules on position sizing, I was psychologically fragile. Every small dip, every 100-point reaction that was perfectly normal for the cotton market felt like the end of the world. The tape seemed to be attacking me personally. I was not afraid of being wrong about the market. I was afraid of a margin call. That fear, born of leverage, made me weak. It made me hold on when my own judgment screamed to sell. It made me susceptible to the reassurances of another man instead of listening to the tape. In the end, I was shaken out of a correct long-term position with a devastating loss simply because I could not financially or emotionally withstand the normal, healthy breathing of the market. My leverage had turned a garden-variety pullback into a financial calamity. The market is an ocean of probabilities with waves and currents. If you build a tiny boat, you will be safe in a calm sea, but the first real wave will capsize you. Leverage is the act of taking that same tiny boat out into a hurricane. The rule is simple. You must size your position so that you can withstand a normal reaction against you without panicking. Before you enter a trade, look at the chart. See how it typically moves. If it often has pullbacks of 5 or 10%, you must be capitalized to endure that without breaking a sweat. If a routine dip threatens to force you out of the trade, you are not speculating. You are holding a lit stick of dynamite and praying the fuse is a slow one. The fourth sign is the most dangerous because it masquerades as ambition. It is the moment you stop trading to win and start trading because you need to win. The market is a cold, impersonal force of supply and demand. It has no awareness of your personal circumstances. It does not know that you need to pay your rent, or that you want to buy a new car, or that you are trying to make back the money you lost on your last disastrous trade. The moment your personal needs enter your trading calculations, you have lost the game. Desperation is a scent the market can detect from a mile away. When you need a trade to work, you lose all objectivity. You will see bullish signals where none exist. You will ignore bearish warnings that are as plain as day. You will hold a losing position far past your stop, hoping, praying, bargaining with a market that cannot hear you. Why? Because the alternative, accepting the loss, is not just a financial setback, but a crushing blow to your desperate hope. This need is the father of over-leveraging. A man who is trading with a calm mind and a sound account takes small, calculated risks. A man who is desperate goes for the knockout punch. He bets too big because he is trying to solve all of his life's problems with one single trade. I've been broke more than once. The journey back is a slow, methodical process of rebuilding capital and confidence. But the temptation is always there to shorten the process, to take one massive risk to get back to where you once were. This is the gambler's instinct, not the speculator's. I have also made the mistake of trying to make the market pay for my luxuries. I would decide I wanted something, a new yacht, an annuity for my family, and I would enter the market with the express purpose of extracting that specific amount of money. It never works. The market gives you what it gives you when it gives it to you. You cannot make demands of it. The rule is this: never make a trade from a position of need. Your decisions must be as cold and impersonal as the numbers on the screen. They must be based on market conditions, not your personal condition. If you feel that you absolutely must make a profit today, then that is the one day you must not trade at all. Close your screens. Go for a walk. A desperate trader is a predictable trader. He will buy the top out of fear of missing out, and he will sell the bottom out of sheer panic. The market is a machine designed to transfer wealth from the predictably desperate to the patiently disciplined. The fifth and final sign is the ultimate betrayal. It is when you begin to shatter your own rules. Every successful speculator I have ever known lives by a code, a set of cardinal rules forged in the fire of his own losses. These rules are his armor. They protect his capital from his own worst instincts, his greed, his fear, his hope. Rules like always cut your losses quickly, never average down, never listen to tips, trade with the trend. These are not just catchy phrases, they are the bedrock of survival. Over-leverage is the psychological acid that dissolves this bedrock. When the pressure of a massive leveraged position becomes unbearable, discipline is the first casualty. You will find yourself rationalizing. You will look at a losing trade that has hit your 10% stop loss and you will say, "I'll just give it a little more room. It's bound to come back." Why are you breaking your most important rule? Because you are over-leveraged. The loss, even at 10%, is so large in absolute dollar terms that you cannot bring yourself to take it. The pain of realizing that loss is too great, so you gamble on hope instead. You will average down, throwing good money after bad, convincing yourself you are lowering your average cost. You are not. You are simply compounding a mistake. I did this in the cotton market. I broke all my own rules. I took a tip from another man. I held a losing position. I argued with the tape. I listened to another's opinion when the price action was telling me I was wrong. I did all of this because my position was so enormous that admitting I was wrong was not just an intellectual exercise, it was a financially devastating event. The leverage created a situation where my judgment was paralyzed by the sheer magnitude of the consequences. It makes a coward of you, forcing you to abandon the very system that brought you success. The rule is therefore absolute. The moment you find yourself consciously breaking one of your own cardinal rules, you must exit the trade immediately. It does not matter if the trade miraculously turns around and becomes a winner. By breaking your rule, you have already lost. You have proven that your discipline can be compromised, that your system is vulnerable. You have planted a seed of corruption in your methodology that, if left unchecked, will grow until it chokes your entire account. The small profit you might gain from a rule-breaking trade is not worth the cancer you introduce into your discipline. Your rules are the only thing that stand between you and the poorhouse. Leverage is what tempts you to abandon them at the city gates. These 5 signals: insomnia, obsessive checking, fear of normal reactions, trading from need and breaking your own rules, are not 5 separate problems. They are the 5 heads of a single monster. Trading too large for your capital. Leverage entices you with the promise of accelerated profits, but it is a siren's song leading your account to its doom upon the rocks of a margin call. The game of speculation is not won by the man who makes the most, but by the man who survives the longest. Survival is a game of defense, and the cornerstone of a good defense is prudent risk management. If you see any of these signs in your own behavior, do not ignore them. Do not rationalize them. They are the market's final courtesy call before it comes to collect on your mistakes. Act immediately. Reduce your size. Sell down to the point where you can sleep, where you can walk away from the screen, where a normal pullback is interesting, not terrifying, where your trades are a matter of cool calculation, not desperate need, and where your rules are once again unbreakable. A speculator's capital is his lifeblood. Protect it with a ferocity that borders on paranoia, and you will live to trade another day. The big money is not made in the buying or the selling, but in the waiting. And you can only wait if you haven't been wiped out by your own foolishness.